Adjunct Professor Moran, Macroeconomics 111. In the last session, 2 sessions ago, we discussed changes in output caused by a small change in spending. In particular, we discussed how, we were discussing the multiplier. We were discussing how a change in government spending of 15 from 490 to 505 could cause a change in output of 60. And so we're going to take a closer look at how the multiplier works and the difference between a tax multiplier and a spending multiplier. The spending multiplier will always be one larger than the tax multiplier. The tax multiplier will always be one less and a negative. Okay. So let's assume that we want GDP to change by 20. And we have a marginal propensity to consume of 0.75. So what we do here is we're going to marginal propensity to consume, marginal propensity to save. 0.75, 0.25. Marginal is how likely propensity are you to spend, consume an extra or marginal dollar? How likely are you to save it? Since there are only two things you can do with a change in income, spend it and save it, these always have to equal 1 when added together. The formula for the multiplier is, the spending multiplier is 1 over 1 minus the marginal propensity to save, which also equals 1 minus the marginal propensity to consume, which also equals 1 minus the marginal propensity to save. This is an inverse. When there's a number underneath a 1 divided by something, that means it's an inverse. So the multiplier, the spending multiplier, is an inverse relationship with savings. Because savings is a leakage. The more money that leaks out, the less bang you get out of the multiplier. So this becomes 1 over 0.25. So the multiplier equals 4. The tax multiplier, this is going to be the spending multiplier. The tax multiplier is a formula of negative marginal propensity to consume divided by the marginal propensity to save. That's 0.75 divided by 0.25, a negative. That's a negative 3. Always 1 less and a negative. So, if we want GDP to change by 20, the formula is change in GDP equals change in spending, aggregate expenditures, times the spending multiplier. Let's say we want GDP to change by 20. We don't know how much spending has to change to get us back to, say, full employment. We know the multiplier is 4. 20 divided by 4 is 5. A change in spending of 5 will cause a total change in GDP of 20. It's multiplied for reasons we'll discuss shortly. Gross domestic product equals change in taxes times the tax multiplier. GDP change of 20, we don't know what that is. We know the spending multiplier is 3. This is going to be a tax cut of 6.7, is the change in taxes that's necessary to cause a change in GDP of 20. It's larger because part of this tax cut is going to leak out, and not so the tax multiplier will not be as powerful as a change in spending. So here's our initial change in spending of 5. Does it count? So it's going to count as income. One person's expense is another person's income. So this is the change in income that results from the government, say, spending 5, a change in aggregate expenditures. Now, when someone catches that, does the initial change in spending count as part of GDP? And the answer is yes. Now, when someone catches $5, they're going to spend 75% of that. And 75% of $5 is $3.75. And they're going to save 25%, which is $1.25. Now, when they spend that $3.75, someone else is catching that as income, and they're going to spend $2.81 worth of that and save the remainder. Does this change in 281 and 375 count? Yeah, if they spend it, well, no, let's see, 281. Yeah. This 281 counts. Somebody catches the 281 as income, and they spend 75% of it, 211, and save the balance. That counts. You can always take 75% of a number. Theoretically, this could go on forever. But what happens here is these will add up to $15. But this original 5 counted, and so that makes a total change in GDP of 20. The original change in government spending counts as a change in GDP, as well as a change in income. So when you add them all up, you'll get a total change in GDP of 20, resulting from an initial change in government spending of 5. But now let's take a look at what happens when you change taxes. If you give somebody a tax cut of 5, that does not count as a change in GDP. Someone's going to consume 75% of that, or $281, and save the rest. Someone catches that $281 as income, consumes 75% of that, and saves the rest. And this goes on for, it's a limit problem in calculus. It goes on until you hit $15. And what happens here is this part is the same as that part. It adds up to 15. The difference is the original change in government spending does not count. There's nothing here. So you only get the 15 because the first 5 leaked out. Part of the first 5 leaked out because part of it was saved. And that's why a change in government spending, or any spending, will be larger than a change in a tax reduction by a factor of 1. Now, what do I mean by a factor of 1? 4 minus 3 equals 1. What was the original factor value? 5. What was the difference between the change in government spending and the change that resulted from a change in taxes? 5. We'll see more examples of this going forward. But this explains why a change in government spending is larger than a change in taxes. Because the original round counts when it's government spending and does not count in a tax cut. Because part of the this is 100% change in GDP. If the government buys something, that's GDP. But here, when the government gives you a tax cut, it's a change in income, which is then partly spent and saved. And so this will not be as effective.